for joining with me today on the path to financial freedom. The core belief of this channel is to empower everyone in achieving their financial freedom by promoting financial literacy. Let's get you behind the wheel of financial decisions. Not your friend, not a financial advisor, not anybody else but you. You got to make your financial decisions. In this episode, I'll share with you all my portfolio updates and then I will spend some time to get into the details of why I'm buying Facebook or why I'm buying more of it. If you're here for the first time, welcome to my channel. My name is Pawan, and I make these episodes to share my path to financial freedom, the decisions I take along this journey, the good, the bad, and the worst. I'll commit to sharing them transparently and explaining my learnings from those decisions and moving on. Let me confess, I'm not a certified financial advisor, so anything I say in this video or on my channel is for informational purposes only. I strongly encourage you all to seek financial advice from a competent financial planner and further do research before you arrive at any investment decisions. If this kind of content is appealing to you, I would appreciate if you subscribe to the channel and enable the notifications so you do not miss a beat as I post the future episodes. Let's kick off this episode. First up, here is the growth portfolio. We are in the red by a little bit, by about $300. So as you can see, back on September 16th, the portfolio value is over 25,000, 25,400, and it dipped all the way down to what is this, like $24,100. So it's like it dipped by quite a bit, like more than $1,000. And in the next few sessions, like 3-4 sessions of trading, the value picked back up to 25,102. And here we are, down by a little bit. But then let's jump into the holdings to see how things are, because I've reorganized as I've shared in the previous posting. So in here, what I typically try and do is to look at what are the top two and the bottom two holdings. So what are the top performers and the top detractors, and looks, there's this weird thing with respect to M1 portfolio that it only allows you to sort based on the percentage gains, but then based on dollar amount, it's basically snow and actually let me do it based on value. So snow, I am in the green by quite a bit, 300 something dollars, and Google, I'm in the green by about 160. So those are my top two performers. And the bottom two performers are actually Alibaba, where I'm in the red by about $137, and then it was Facebook. Even now it is about $75, but it was actually Facebook. I was in red by 150 something dollars until last week. So those are my top two performers and top two detractors. What I'd like to look week over week in my portfolio is the cumulative performance of these four stocks, the top two performers and the bottom two detractors. As long as the cumulative performance of these four stocks is in positive, the portfolio is in good shape. At the moment, I am barely in the green. The cumulative performance of Facebook, Alibaba, what is that? Yeah, so Alibaba 28% in negative, Facebook 2% down, Google I'm up 10%, Snow I'm up 20%. So I'm like cumulative performance, as I said, I'm barely in the green by about 1.2, 1.3%. So that's what it is. I'll continue to track them and see how the portfolio performs. And I'll continue to find opportunities in the market to keep buying quality companies. In this journey, one thing I'm not going to try though is to time the market. I dollar cost average my positions over a period of time into good quality companies. Why? Mr. Buffett is easily one of the top 5 investors of all time, and here is a piece of advice from him. No, it doesn't come from him today, not a year ago when we were all fearful about the pandemic highs, nor did it come from him during the 2008 recession. It dates way back. Here are all the letters that Mr. Buffett shared with Berkshire Hathaway shareholders, and when we date back to 1986, that is more than 3 decades ago, that is where we can find the reference to one of his most famous quotes. Let's go in there and search for that, and there you go. That's a quote more than 3 decades old. Our goal is more modest. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. If I only get to take one advice from this man, that got to be this. Mind you, though, as simple and meaningful this advice might sound, it's extremely difficult to follow this in practice and to not give in to temptations when everyone around you is talking about how they are killing it with this new whatever shining thing they are investing in, you're staring at your portfolio and you're like, okay, wait a second, what is this? It's just giving me like what, 7, 8, 4, 12, whatever percent it is making. But then looking at your portfolio, it takes a lot of discipline to stay put and not get carried away in greed to chase returns. At the same time, when there is blood in Wall Street and everybody and their uncle is starting to dump stocks indiscriminately with no regards to the underlying fundamentals or what stock, what sector, there is blood everywhere. When that's going on and all major financial outlets, they've kind of leased for life fire as their wallpaper. When that happens, it takes nerves of steels to hold back at the very least. And God be with those brave souls who jump both feet in and buy when there is blood in Wall Street. So it's very difficult to follow that advice, no matter how simple and meaningful it is. So I'm just trying to practice and build that muscle. And one of these days, I'll get there. Guess what though? We do not have to just take one advice from him. So let's pick one more.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up.
Okay, there you go. Warren Buffett is saying, I never know what markets are gonna do. I never knew it in my whole entire life. But in general, over a long period of time, they are gonna go up. It's got to be an easier advice both to comprehend and to implement. For one, I'm a net buyer of stocks in general. I might not be a net buyer of a particular company. That decision will keep changing from time to time as information presents itself or as better opportunities present themselves. But over the next, say, 10 to 20 years, I expect to buy more than what I hold today in the overall market. So the short term fluctuations should not deter me or anyone for that matter in the process of wealth building. So there you go. That is the reason why I do not plan to time the market. I'm going to continue to dollar cost average. I'll do my research, identify quality companies, and continue to invest in them. Those are all the portfolio updates for this episode. Now let's get into why I am buying more Facebook. Here goes my Facebook research journey. 1. Brand recognition and awareness. Facebook is no stranger to people. Almost everyone knows it and use at least one of its popular communication channel, be it Facebook, Instagram, Messenger, or WhatsApp. Like iPad has grown synonymous to tablet or Google has grown synonymous to search, Facebook has quite literally established itself as the generic name for social media. Number two is brand value. Besides the brand recognition, this social media giant commands a huge brand value. Let's delve into that detail. In 2021, of the most valuable brands in the world, Facebook's brand value is assessed to be anywhere between 147 billion to about 8 billion, depending on what source I've used. Here on my screen, you can see Facebook's brand is valued at about 147 billion on this source. Now, if I get to Forbes, let me scroll down. Facebook is valued at about 70 billion, and on this source, Facebook is valued at about $8 billion. As I said, depending on the source, the value is assessed anywhere between 147 to about $8 billion. But almost every source has ranked Facebook as number 5 or number 6 top brand by value in the world. Now, it's the usual suspects Apple, Microsoft, Google, and Amazon which are ahead of Facebook. Given these different sources calculated the brand value based on different methodology, there is a huge variation in the total value. However, Brand value does not translate into the financials, so I am not hung up on this wide deviation or variance between these values, and nor should any of you concern yourself with it. Number 3 is market. Facebook is in digital advertising business. I have specialized in web technologies in college and then gained many years of professional work experience on digital advertising platforms. With that background, what I can tell you all is digital advertising is eating the lunch of advertising and marketing agencies at large for one simple reason: the efficacy of ad campaign results. The efficacy of ad campaign results are extremely hard to measure on the traditional advertising platforms, be it the billboards, televisions, magazines, radios, any of these. Digital advertising, on the other end, offers very granular insights to the campaign managers and the advertising agencies. That is precisely what brands love and want. Companies want to know how their advertising dollars are producing results in converting new customers or maybe retaining existing customers longer. Whatever their advertising campaigns, goals, and priorities are, they would like to be able to track how the campaign is delivering results. That is precisely the reason why global advertising spend has been growing at about 10 to 15% year over year and is expected to cross $500 billion in spend by 2023, which is not far off. And not just that, it continues to claim a larger piece of the total ad spending pie by about 2 to 3% year over year. As you can see, the share of digital advertising of the total ad spending across the world has been growing like from 45% to about 50%, 53%, 56%, 58, and 60%. That's how the share of digital advertising is growing of the total advertising spend across the world. So Facebook is clearly in a growing market. With that context, let's delve into the next topic. Number 4 is market share. How big is Facebook's share in the global ad spending pie? According to this report, Facebook has 77% market share in the social networks ad revenue. And according to this report, Facebook has 20% market share of all digital advertising worldwide. It is just behind Google, which is currently at about 31%. So, no matter how I look at it, Facebook has a large market share in digital advertising spend and quite literally is dominating the social media space. Facebook enjoys a wide moat with consumers, has a very deep brand recognition, commands one of the top brand values in the world, operates in a growing market with a dominant market share, especially in the social media and the mobile space. So, what could go wrong with this company, all right? Let me cut the chase and go buy the stock. Well, we have so far primarily only taken a look at the macroeconomics within which Facebook operates and how well it is positioned from a qualitative aspect. Now it's time to start delving into numbers. Number 5 is market cap. Do you all realize how big is Facebook? Honestly, I've not realized it until recently when I've had a disagreement with someone who was referring to Facebook as big tech. I was like, why would you refer to Facebook as big tech? Well, the answer is Facebook is the fifth largest publicly traded company in the world with almost $1 trillion market cap. Thanks to the recent market sell off, especially in the tech sector, the valuation of Facebook is now shy of the $1 trillion mark, which I am sure would bounce right back over the $1 trillion mark over the next few days. Within the technology sector, Facebook is like as you can see, within the technology sector, Facebook is right behind Microsoft and Google, so it is the third largest technology company in the world. With a market cap that high, Facebook got to be extremely overvalued, right? Let's delve into that next. Number 6 is value. There are many valuation metrics we could use to assess the performance of any public traded company, and I have reviewed most of them for Facebook before making my investment decision in Facebook. What I'll walk you all through is PE ratio or price to earning ratio, which is one of the most important valuation metrics. Facebook has been steadily inching down on the PE ratio over the last decade. Like as you see earlier on, they were in the high hundreds or so multiples to the earnings, which is typical of any growth company or hyper growth company, the way it was back in 2013-14 time range. After 2016-2017, as I said, they've steadily increased their earnings, which has caused the PE ratio to start come down, and right now they are maintaining the PE ratio in the low to mid 20s. Right now, in September 2021, their PE ratio is standing at 25.17. Now let's see how Facebook's PE ratio compares to S&P 500. S&P 500 PE ratio is currently at 34.02 as of October 1st. Facebook most certainly is a better company with a wide moat and pricing power with its consumers and customers, and has an even stronger financial performance compared to an average S&P 500, and still it is priced at a lower price multiple as compared to S&P 500, which tells me there is upside as long as Facebook continues to perform the way they are today. Let me do a quick check on a few other valuation metrics. The consensus forward PE is at 22.08, the price to sales ratio is at 9.36, and the price to book ratio is at 6.92. Those metrics are looking good. Let's get to the next topic, number 7, revenue. As far as the numbers go, if you do not have time, you know what? You actually better make time before you invest. Yes, you better make time before you invest. There are no excuses. At the very least, there are two numbers you got to review before you invest so your future self won't accuse you of criminal neglect. Total revenue and net income. What I'd like to see in any company that I'm going to invest is a steady upward trajectory for both these metrics. Why do I care about it? That is because if a company does perform well and shows a steady upward trajectory for both these metrics of total revenue and net income, then such a company has more room for error and they can easily bounce back from any setbacks. What that means to me as an investor is I have margin of safety with this company in terms of short-term setbacks. The company can dip into its deep pockets and fix itself and come out of the situation that they might find themselves in. Facebook's total revenue has this nice and steady upward trajectory. Look at the last 7 years, how the revenue kept growing. It grew from 12.48 billion in 2014 to 17.9 in 15 to 27.6 in 16 to 40 billion in 17 to 55 in 18 to 70 in 19 to about 85.9 billion in 2020. In just the last 3 years, the revenue kept increasing at about 15 billion year over year. That's a phenomenal growth, which is extremely difficult to pull off year over year, and Facebook management has done a fantastic job in achieving that. Now, mind you, as impressive as this revenue growth trend might seem, what if Facebook is burning billions on sales and marketing and traffic acquisition costs for its advertising? Or simply, what if Facebook is spending a lot to earn a lot? To ensure that ain't the case, let me review their net income. Facebook's net income also has an equally impressive upward trajectory, except for this one sore spot. For the same 7 year period, their net income grew from 2.9 billion in 2014 to about 29 billion in 2020. That is a 10x growth in profit in a 7 year period. You got to love that number, dude. What else are you researching? Let's place that trade now. Well, I admit that is very compelling. That said, I am accountable to my future self, so let's continue the research. That sore spot in 2019 was a dip in net income in 2019, and that's the only anti-pattern which ought to be looked into. There could be a lot of reasons why the net income of any company could dip. Although there are a few good reasons, and I'd like to validate if Facebook's dip in 2019 is because one of those good reasons. What are those good reasons, you may ask? A company might make a large acquisition or authorize a major debt payoff or a stock buyback program. These are examples of capital expenditure. Or they may choose to make a large investment in talent acquisition to organically expand the company from within, which could be the example of research expenditure. If I see these kind of expenditures by a company and that is what is leading to the dip in their net income, I would feel much comfortable making my investment, because these, in my opinion, are not expenditures. These are investments that the company is making into their own future. These are investments into productive assets which the management team believes would return shareholder value in multiples over the next few years. In case of Facebook, they had a 15 billion capital expenditure both in 2019 and 2020. So that is $30 billion in capital expenditure. How do I know that? Well, if you're serious about investment, here is one thing I want you all to get comfortable with: finding, reading, and understanding the annual reports. Before you make investment in any company, find their latest annual report, ideally the last two annual reports, understand what the company does, how are they doing financially. That is the best source. You could refer to a lot of websites, but there cannot be a better source of financial information about a company other their annual report. Once you get your hands on the annual report, at least review the top section, which is usually named the financial highlights, and also pay attention to the footnotes. Again, if you do not have time, that's not an excuse. Make time, review the annual report, familiarize yourself with what the company is doing before you make an investment. So now let me take you to Facebook's annual report for 2019 and 2020. That's basically from where I found out that they've made a huge capital expenditure in both 2019 and 2020. Here is Facebook's annual report for 2020, which they released in January 2021. I scrolled down to the financial highlights section on their report. The financial highlights section gives you a quick summary of the financial health of the company for the period they are reporting. In this case, it is for 2020, and you can review all these numbers for that period and also compare it to the immediate last year, which happens to be 2019, and how it is changing. Right under the financial highlights section, you would see footnotes. This is an important section. This is how the company's management communicate the why behind what the numbers are explaining. So what I'm looking for is capital expenditures. Capital expenditures, including principal payments on finance leases, were 4.82 billion and 15.72 billion for the fourth quarter and full year of 2020 respectively. So as you see, Facebook spent $15.72 billion on capital expenditure, which was towards the principal payments on their finances. So they are paying off debt, and that's what they've done in 2020. Now, that's not where we have seen the dip. We've seen the dip in 2019. So let me pull up the annual report for 2019. Again, here is the financial highlights section. I come down to the footnotes and the capital expenditure section. And as you can see, 15.65 billion was spent for the full year of 2019 on capital expenditure. So Facebook has essentially paid down 30 close to 31 billion, looks like, right? 15.65 in 2019, 15.17 in 2020. So about 31 billion is what they've paid down in finance leases. So they are reducing their debt burden for the long term. That is a fantastic thing and the prudent thing for the management to do. Now let's go back to the same 7-year period and look at Facebook's free cash flow. As you can see, their free cash flow positions have been improving year over year, and it increased from 5.49 billion in 2014 all the way up to 23 billion in 2020. So Facebook spent $15 billion in capital expenditure both in 2019 and 2020, and yet have a free cash flow of 21 billion in 2019 and 23 billion in 2020. That gives me a great insight. The management team is not dipping into past or future revenues for their capital expenditure, or they are not using any leverage whatsoever. They are marshalling the current year revenue to finance those large capital expenditures and still come out on the positive end on the other side, and leaving 18 and 29 billion dollars on the table for 2009 and 2020. Armed with that context, this sore spot on Facebook's net income trajectory is not bothering me as much anymore. Is that why I am buying more of Facebook stock now? No. Then what is it? Number 9, disruptive products.
Hey everyone! We've believed for a long time that glasses are going to be an important part of building the next computing platform and unlocking a whole new set of experiences for people. So I'm excited that today we finally get to share what we've been working on with Luxottica. We wanted to build something that would enable you to easily capture and share experiences from your point of view. And we thought, if we're going to build best-in-class glasses, a great place to start is with the iconic Ray-Ban frames that people already love. So I'm proud to introduce to you RaybanStories. With RaybanStories, you can capture photos and videos, listen to music or podcasts, or take phone calls, all while staying in the moment and without even taking out your phone. Whether you're on a hike, cooking, or just hanging out or playing outside with your kids, you're going to be able to quickly capture that experience and share it if you want to. And this is just the start. RaybanStories are an important step towards a future when phones are no longer a central part of our lives. And you won't have to choose between interacting with a device or interacting with the world around you. We worked with Luxottica to design an experience that combines the style that you expect from Ray-Ban with as much technology as we can fit into these classic and iconic frames, starting at $299. So let's take a look.
Here is Steve Jobs at a 2010 Apple event when he introduced the iPad for the first time. iPad ushered Apple into a new business. As part of his introduction to the iPad, Steve thought we all need a new category of device, something in the middle of a laptop and a smartphone, something which can do some of these tasks way better than both a laptop and a smartphone. And that's what led to iPad. Although it was originally introduced in 2010 as a consumer device, a decade later, iPad is adopted in a huge way in the business space. I believe that is exactly what the Ray-Ban stories would do to Facebook. So I agree with Mark when he says this is just the start. Number 10 is revenue diversification. While Facebook is currently growing at 55% year over year, it will start to become increasingly difficult to maintain that high growth rate at that high margins. Facebook brings in its revenue in just two segments, advertising and payments. And as you can see, the percentage of revenue contributed by advertising continues to be exactly the same, or at least directionally the same. So from a diversification point of view, this could become a risk in the long term. That is precisely where Ray-Ban stories could come in. Facebook need a new product segment that could both sustain the growth rate as well as diversify its revenue into the next decade and well beyond. Number 11 is AR and VR market. PS Market Research forecasts that the augmented reality and virtual reality market size will grow from $37 billion in 2019 to $1.27 trillion in 2030 with a compound annual growth rate of 42% during the decade of 2020 to 2030. That is a sizable market to tap into and establish strong lead in. Per the same report of PS Market Research, Sony is the leader in the AR/VR space. Given that this report was published almost a year ago in last September, I've explored to find more recent reports, and here is what I found. The global shipments of AR and VR headsets have hit a record during the second quarter of 2021. Both the consumer and commercial demand remained equally strong during this quarter, and the shipments grew a whopping 126% year over year, is what IDC reports in its recent report that was published on September 23rd, 2021. IDC in the same report also forecasts that AR and VR headset market will continue to grow at an annual compound growth rate of more than 36% through 2025. I further explored to learn if Facebook managed to inch up its market share in the last 12 months or if Sony continues to be the dominant leader in AR and VR like the PS Market Research said in last September. In a recent report published in June this year, IDC believes that Facebook's Oculus has single-handedly driven growth in the market and helped the company manage to capture almost two-thirds share of the global VR headset shipments during this quarter. Now that is promising, even with this footnote of IDC that there is still plenty of room for other players in the market. Facebook, which is already a dominant player in the market with its Oculus headset, could race towards monopoly if they can nail these three things. Gartner analyzed the following three challenges for the takeoff of AR and VR market. Challenge number one is 3D design interface. Challenge number two is convenience and control. And challenge number three is smartphone competition. Although VR is already available to consumers through many devices, it has not moved beyond a niche market. To enter the mainstream, a VR hardware needs to incorporate two most important features, convenience and control, to be able to achieve the mass adoption. Facebook and Ray-Ban's collaboration to introduce RaybanStories, in my opinion, have taken a crack exactly at all these aspects which Gartner touched upon in its report. The 3D interface, we are missing the control and convenience aspect, and the smartphone competition. While they have taken a crack at all these aspects, what they've absolutely nailed is to offer convenience to the consumers. I love how those glasses look. They're not clunky or difficult to use. I could totally see how consumers would be willing to embrace it. Would consumers have a lot of choice in the frame colors, styles, etc. is to be seen. They also have attempted to solve the control aspect by offering the smart glass at a reasonable price point of $299. Now, I'm not expecting that this product line overnight is going to pick up and quadruple Facebook's Q3 results. That's not my intent. However, I'm planning to pay close attention to these three things.
And this is just the start.
And this is just the start. Yes, I agree, this is just the start. What these smart glasses can achieve functionally can and should be innovated further. And like iPad back in 2010, I believe there is a large realm of possibility in this space. Now let's check out the second thing I'm watching out for.
Step towards a future when phones are no longer a central part of our lives.
Did I just hear that? That's a tall order to pull off. But hey, just a few decades ago, mobile phones were not a thing that people relied on to live their lives. And the same applies to smartphones just about a decade ago. So if Facebook and the other AR VR players in the market are able to pull it off, who knows? Maybe phones indeed may no longer be the central part of our lives. And if that happens, it is anybody's imagination on how huge the market dynamics will change when phones are no longer the central part of our lives. Now, let's get to number three. What stands out to you in this frame? To me, it's not those glasses. Well, not yet at least. It is the icons in this footnote. These smart glasses shall continue to bring demand to the Facebook communication channel line like the Facebook, Messenger, Instagram, WhatsApp. That is how Facebook will continue to grow its demand and maintain the growth and revenue that it is able to bring in into the next decade. So those were all the qualitative and quantitative benefits that Facebook is enjoying in today's market. Now, is everything so rosy for Facebook? The number one risk and issue that Facebook is fighting right now, in my opinion, is consumer sentiment and perception about the company. Perceptions are stronger than reality, and the recent attempts of Facebook to launch Instagram for kids is just establishing those perceptions further and make it very difficult for the company to break out of the corner that they already are finding themselves in. Intrigued by this situation, I looked at what is Facebook doing in this space. Let me take you through that next. I've used LinkedIn job postings and searched all the job postings in United States on this keyword privacy, and there are 251,000 job postings in United States on privacy. And then I looked up how many of these are As you can see, of the 251,000 job postings on privacy in United States, Facebook posted 856 of them, which is about 0.3 to 0.35%. That tells me their intent to improve the situation. Although I believe they should up their ante in this space, both by the right talent acquisition and with matching product decisions, which will make it clear to consumers that Facebook really cares about user privacy. As I shared earlier in the video, I researched the Facebook valuation metrics and believe that its price is currently undervalued. However, I'd like to triangulate my research and opinions with analysts. So let's see what their price targets are on Facebook. Here I'm looking up Morningstar's analysis on Facebook, and they also agree that Facebook is undervalued. They believe that the fair value of Facebook should be about $407, and the last close of it today on October 1st is at 343. So Facebook stock has another 20% or so, which is about $60 before it can breach the fair value that is assessed by Morningstar. Now that is a reasonable margin of safety. Okay, there you have it. That was my research before I arrived at my decision to invest more in Facebook and extend my position. Here is a snapshot of Facebook position in my portfolio from this morning before I've placed another trade in the afternoon session. Thanks to the recent sell-off, as you can see on my Facebook position, I am in the red by about $288 or 12%. I hope to build a 30 to 50,000 position in Facebook in my portfolio over the next 2 years. So me being in red at the moment is not bothering me. In fact, that makes me happy as Facebook stock is on sale. That is the perfect opportunity for me to build my position further. So let me show you my trades in Facebook in the last 1 month. I've placed a trade to buy $2,000 of Facebook on September 16th. I've also initiated a position in Atlassian for $1,000, but more on that later. Earlier this afternoon, I've placed another $2,000 trade to increase my Facebook position. I hope those were useful insights and you all can make use of my research into Facebook stock before arriving at your decisions. As I said earlier, it's not me, it's not your CPA, not your friend, not your uncle, or anyone. It's you who should be in control of your financial decisions. So let's get you behind the wheel of your financial success. Read, watch, learn, do whatever you want to do to understand about the companies or opportunities you choose to invest before you invest. Buyer's remorse could be a very costly thing in investing. Thank you all for joining with me today. Hope this episode was informative. If you enjoy this type of content, please do subscribe to the channel and enable the notifications so you do not miss a beat on my future episodes. If you like this episode, please smash that thumbs up button. By doing so, YouTube will recommend my content to more viewers, and that would be a quick and easy way for you all to help me out in growing my channel, and I would really appreciate your help in doing so. Until the next episode, please keep paying attention to your finances, and I'll be back with more investment stories, tips, and my own portfolio updates. Thank you.